And this is actually one of the few times you'll hear Dave say that the government could actually do something.
Dave Ramsey's usually one of the strongest voices for personal responsibility, financial discipline, and common sense economics, which is exactly why this video that he just did caught me off guard. Because in a recent segment on housing, Dave starts with rock-solid economic reasoning and then slowly drifts into policy ideas that completely contradict his own logic, and not just slightly, but fundamentally. The result is an argument that unintentionally supports more centralized control over housing markets, even though the root problem is already caused by too much of it. So let's walk through this carefully, respectfully, and thoroughly, because this isn't just about Dave being wrong. It's about how even smart people can follow correct premises and still arrive at the wrong conclusion. So let's start here because it matters. Dave says housing prices are driven by supply and demand.
House prices are affected always by supply and demand. And we have had an inventory shortage, more buyers than sellers, for about 20 years.
That is exactly right, 100%. If there are more buyers than sellers, prices go up. If there are more homes available, prices stabilize or fall. There's nothing controversial about that. He also points out that we've had a housing shortage for a long time. Also correct. The United States has underbuilt housing for decades relative to population growth and demand. So far, Dave is doing textbook economics. No disagreement. But here's where things start to shift and the first contradiction appears. After correctly identifying a supply shortage, Dave asks, what could you do to boost inventory? That's a great question. But instead of focusing on how to increase supply, he starts focusing on who is buying homes. And that's a pivot. It's the first major contradiction, because if the problem is not enough houses, then the identity of the buyer is irrelevant. Let me say that again clearly. If there aren't enough homes, it doesn't matter who buys them. The problem is still that there aren't enough homes. So next, we want to look at the corporate buyer argument, because Dave points to large corporations, REITs, and even foreign buyers purchasing single-family homes and renting them out.
We've got large REITs, real estate investment trusts, and American corporations and Chinese corporations buying thousands and thousands and thousands of single-family homes and taking them off the market and putting them up for rent. I mean, like 500,000 or 600,000 in the past few years. It's a lot. It's not just a few. So one thing you could do, and I'm really against limiting free enterprise, but when the basic use of a single-family home is for a family to get a toehold in the marketplace and to build wealth and to have a stable place to live, when that's being affected by foreign organizations and by out-of-control capitalism, then, you got to put some limits on that.
This sounds persuasive at first, but economically, it doesn't hold up, because when a corporation buys a home and rents it, that home does not disappear. It is still housing someone. It has not been removed from supply. It is simply shifted from owner-occupied housing to rental housing. And the number of housing units stays exactly the same. So if renters are still living in those homes, where's the supply loss? There isn't one. This is a classic example of confusing who owns housing with how much housing exists. And those are completely different things. So next we want to look at why restricting buyers makes things actually worse. So now here's where the argument becomes dangerous, even if well-intentioned. Dave suggests that when corporations or foreign buyers affect the market, we may need to put limits on it. Those are his own words. But think about that in the context of supply and demand. If you A, reduce the number of buyers, B, restrict capital entering the market, and C, discourage investment, well, what really happens? You don't increase supply, you actually risk reducing it, because builders and developers and investors respond to incentives. Less capital flowing into housing means A, fewer developments, B, slower construction, and C, less innovation. So in other words, you try to fix a shortage by making it less attractive to create supply. That's backwards. And then he goes on to the Airbnb argument. Dave points to Airbnb and short-term rentals as another major drain on inventory.
Yeah.
Another thing that's draining the market is Airbnbs. Tens of thousands of single-family homes, condos, co-ops, whatever, are
Townhomes,
they're bought by people at unrealistic prices only because they're turning them into a hotel. And they're making tons of money, and people are buying 8, 10, 20, 15 of them at a time. And that did not exist 20 years ago. Okay? And so some kind of a limitation, not necessarily a complete stopping of that,
right,
but limiting the number of units that go off the market so that a young couple getting married have a house to buy instead of it turning into an Airbnb.
And this one has a kernel of truth. Yes, some homes are converted from long-term housing into short-term rentals. But again, this only becomes a major issue when supply is already tight. In a healthy market with abundant housing, Airbnb has minimal impact on overall prices. In a constrained market, every unit matters. So Airbnb is not the root cause. It's simply a magnifier of an already existing problem. And the real question remains unanswered. Why is supply so constrained in the first place? That's a vital question. So we want to move over to the missing piece in Dave's analysis. And this is the biggest gap in the entire argument, in my opinion. Because the primary reason housing supply has not kept up is not corporations. It's not Airbnb. It's not foreign buyers. It's restrictions on building. Across the country, we see A, zoning laws that prohibit dense housing. B, minimum lot sizes that limit how many homes can be built. C, lengthy permitting processes that delay construction for years. And D, regulations that dramatically increase building costs. In many areas, it is literally illegal to build the amount of housing the market is demanding. So when supply is artificially restricted, prices rise. That's not a failure of markets. That's exactly how markets respond to constraints. Next, Dave then suggests that raising the capital gains exemption on home sales to encourage older homeowners to sell and free up inventory.
So it's been, I need to look it up when it was, but it's at least 20 years ago that the capital gains law on single-family homes was changed. And it was a big deal. It used to be that you got a tax break a little bit on your personal residence, and they changed it massively, whatever it was 20 years ago, and said, okay, married filing jointly, you can make up to $500,000. Single, you can make up to $250,000 tax-free
on the growth of your
capital
home.
gain on your personal residence if you own it 1 year or more. Okay, and that was a big breakthrough. Well, guess what? $500,000 isn't much anymore. And he said raising that to $1 million would take a bunch of boomers
out of their home
that would say, I would downsize, but I'm going to have to pay so stinking much tax that I'm not going to downsize. And see, if that level will sell, the next level sells to move up into that, and the next level below that moves up. You create a domino down the price points. And so giving $1 million exemption instead of a $500,000 exemption, and even do it on all small ownership. So if you had 2 rentals and you want to dump them, and you can make up to $1 million, you dump those back into the inventory pool for that sweet young couple to have a place to buy. But they don't want to get rid of that rental because the tax,
the amount of taxes.
And there is no capital gains break on that, except you're paying 15%, or if you make over $400,000, you pay 20%.
Right.
So you get hammered if you've got a house. Like I've got a bunch of houses. I probably got 15 houses. Most of our real estate's not houses, but I got 15 or 20. And I would dump those stupid things because I got a lot of gain in them. But I'm not going to give the government a bunch of money. So I'm going to have to do some kind of 1031, roll them, and I'll get them back out of the market and turn them into commercial property. But most people won't do that. I actually know how to do it. Your husband and I will be doing that together. So, but if you gave people a tax break on the rentals that they own and a tax up to $1 million, and on their personal residence, there'd be a bunch of houses going to market.
This one actually is one of the more reasonable ideas that he presents. Lower taxes can increase turnover. But even here, you have to be honest about scale. This might slightly increase listings or even improve movement within the market, but it does not solve the core problem because it doesn't create new housing. It just reshuffles existing housing. And when demand still exceeds supply, prices remain elevated. So here's the core issue. Dave starts with this premise: housing prices are high because supply is too low. That's correct. But then his solutions focus on restricting buyers, limiting certain uses, and adjusting tax incentives, none of which meaningfully increase supply. And that's the contradiction. It's like diagnosing a food shortage and then proposing limits on who is allowed to buy groceries. That doesn't produce more food. And this is where the conversation becomes bigger than just this one segment, because when influential voices say things like markets are out of control, or we need to limit participation, or even worse, government should step in, even if they mean well, it reinforces a narrative that the solution to economic problems is more centralized control. But history shows that when housing markets are heavy and prices rise long term and allocation becomes even more inefficient, you end up treating symptoms instead of causes. So what actually solves the problem? If we take Dave's original point seriously, then the solution is actually pretty straightforward. Increase supply. And that means making it easier to build, reducing regulatory barriers, and allowing higher density where demand exists. Another thing you could do is streamline approval processes so it doesn't take years to get an approval. And when supply increases, you'll find that prices stabilize, competition improves, and housing becomes more accessible, not because of mandates, but because abundance replaces scarcity. Dave Ramsey is not wrong about the problem. He's wrong about the solution, and that distinction matters because once you accept the premise that supply drives prices, you have to follow that logic all the way through, not stop halfway and pivot into restrictions. The housing crisis is not caused by too much freedom in the market. It's caused by constraints that prevent the market from doing what it does best, and that is meeting demand. And until that's addressed, every other solution is just rearranging the pieces on the board. It's not actually fixing the game.